Hey everyone, welcome back to Corporate Decoder. Today we're diving into a 10K report so dense it's practically a black hole of corporate jargon. Get ready for a wild ride. We're uncovering the good, the bad, and the potentially ugly hiding inside Vivakor's annual filing. This company has big plans, but their financial reality might surprise you. We're talking about transportation, oil storage, and even trying to clean up oil spills in Kuwait. Sounds ambitious, right? Let's see if their books match their ambitions. First off, this is their financial report for the year, meaning a deep look into everything that went on in their company for all of 2024. The date is important, but even more important are the numbers. One interesting fact is that the company had a public float, meaning the shares owned by regular investors of around $58 million last June. So not a small company, but definitely not a huge one either. Alright, so what exactly does Vivakor do? They operate in transportation, logistics for trucking oil, and they have storage facilities. They also want to do oil remediation, basically cleaning up contaminated soil, but more on that later. It seems like trucking is a big part of their game. They mention a trucking fleet that hauls a lot of crude oil and water used in oil production. They even have deals with big names like Pilot, that's the Pilot gas station company. Now for the cleaner sands part, they plan on using their remediation processing centers, which they call RPCs, to clean up oil spills, including some from the Gulf War and Kuwait. That's a pretty ambitious goal, and it seems to be quite a lucrative one at that. But things got a bit complicated with their Kuwait project. They were originally working with a company called DIC, but that deal fell apart. They're now trying to work directly with the Kuwait oil company. Also, they had to write down the value of their Kuwait assets because it's not clear if they'll actually get that contract. It's always a red flag when the success of something depends on operations happening very far away. Vivakor has a 45-mile pipeline in Oklahoma, mainly used for transportation. The operation is underpinned by two key agreements. The bad news is that one of these agreements, one with White Claw Crude, is tied to the CEO. Let's dig into this further. They own a storage facility in Texas, and it looks like most of the oil stored there comes from, you guessed it, White Claw Crude. In fact, this is such a big relationship that there's a clause in place that ensures they are paid a minimum, irrespective of how much they store for them. They have another storage facility in Louisiana that also relies on White Claw. What is interesting here is that they are guaranteed a profit margin per barrel. In 2024, they organized a commodities trading division, which has certain credit-related contracts with WC Crude, again, a common theme in this company's operation. So what are the risks? Oil and gas is a volatile industry. If drilling stops, Vivakor's revenue could dry up quickly. The company is heavily reliant on just a few customers. Losing one of those could be devastating. Their water transportation business could also be at risk. If oil companies switch to methods that don't require as much water, Vivakor's water hauling business could suffer. On the legal front, there are a few lawsuits. One is about unpaid bills, another is a wrongful death lawsuit, and another seems to be over property taxes. While lawsuits are almost a normal part of doing business, it is always important to keep these in mind when considering investing in a business. Here is another scary one. The company admits they have material weaknesses in their accounting. That's never good. Basically, this means they don't have enough people checking their numbers, which could lead to errors. This is very important because if the company books financials with inaccurate numbers, you may be investing in something that doesn't exist. Revenue increased. They say that their revenue went from 59 million to 89 million. That is a good sign. But dig a little deeper and you find that a massive chunk of that revenue comes from just two customers. If either of those relationships sours, that could be a huge problem. That's called concentration risk. Here is what I would consider the most alarming number. They have an accumulated deficit, a total amount of losses accumulated over their years of $99 million. This is a pretty large number compared to the 58 million public float we mentioned before. Their auditors are raising concerns about whether they can continue as a going concern. This means there's doubt about whether they'll have enough money to stay in business. Again, a massive red flag that investors need to consider. One trend that should be mentioned is how high their general and administrative expenses were. Those are costs for just running the company. These costs were close to 20% of their revenue and are more than double than the year before 2023. This might suggest there are a lot of inefficiencies happening and is probably worth asking management about, although they will probably say that this is one-off. Vivakor has some investments in other companies, most notably Scepter Holdings. This is actually pretty common. Companies sometimes invest in other companies to gain a position in the market, and while this is not exactly debt, they also have shares of preferred stock that have certain obligations on it. Also, the cost of acquiring Endeavour entities, as mentioned previously, was over 100 million. A company needs to make a lot of profit to make these kind of acquisitions work. Now let's put this all together. Vivakor is in a tough spot. They're trying to grow, but they have a lot of debt, big losses, and rely on a few key relationships to support a lot of their revenue. Their accounting issues add another layer of risk. On the positive side, they're trying to diversify with their cleanup operations in Kuwait, and they are definitely trying to expand. Their relationship with Pilot is also a major positive. If you're thinking about investing, you really need to weigh these risks and opportunities carefully. What is the direction of the company? In my opinion, they need to stabilize their finances, improve their internal controls, and prove they can make money without relying so heavily on the CEO's related companies. That's all for today's Corporate Decoder. Make sure you hit the like button and subscribe for more deep dives into the world of corporate finance.